Hey everyone, how are you? Good afternoon and good morning. Yeah, so we have people from different state, coast to coast. Welcome to our seminar. I believe everybody know the beginning of the year, and it's about the time to get ready for our tax filing. Actually, tax filing start already kick off this Monday, January 26th. That means IRS start getting the return, processing the refund. That's the reason we have the seminar today. We want to help people to really instead of worrying how much we have to pay for this year, or we don't know how can we save more taxes in the future. And today we will go over that to help people to navigate the complicated the tax system. Yeah, so today our first speaker, Svetlana, and she will talk about the concept, about the taxes and market risk control to help people to have a more like a better retirement life to fulfill their dreams and goal. And then the second part, I will give some examples. Yeah, so that's today's kind of agenda. So Svetlana actually has a IT background. Yeah, so she transitioned to our tax field maybe around 6 years ago, right, Svetlana?
Yes.
Oh, you can turn on your camera now. Yeah, so we can see your beautiful face. Yeah.
Hello.
Oh, Svetlana, she has a really strong IT background. And then right now she is in the tax field as a certified tax preparer because she want to contribute her knowledge and she want to help more people, small business owner and families to figure out how to save your hard-earned money and really compound your savings. So without further ado, we have Svetlana to start the first session. Okay, okay, come on a second. Okay, let me share the screen. Yeah, okay. So you will see our brief intro a little bit here. And then this is a disclaimer for everybody. This seminar is for educational purpose only. So if you want to know, whether that will apply to you or not, or you want to look for any tax, investment, or legal advice, please go to your professional tax advisor, CPA, tax specialist, or tax attorney for that. Yeah. So it's purely for the educational purpose. Yeah. Okay. So, okay, you can take it over, Svetlana.
Okay. So we make money and invest. Some of our insurance product will pay no income tax. That is Roth or cash value policy. Let's take a look on first. Everybody, including me and Grace, familiar with this ordinary income tax bracket. We work for W-2, we work for 1099, we own business. Even we started retirement. When we started retirement, we will receive some distribution. Everything will be taxed with these brackets. So it is, you can see it based on those tax brackets, it can be 0 or can be 12%, 12%, 27, and maximum 37%. So based of this, you can imagine how much taxes we need to pay. And this is also, we continue to have our life. So why is tax our concern to our wealth? Why it is? Because sometimes we need to spend money for something else, right? Also, we would like to protect ourselves. We would like to invest long term. For example, we would like to invest in stocks and say 5 years ago, I bought stocks for $100. And today I would like to sell because I needed them. So my tax bracket, you can see in this one, investment long-term capital gain tax bracket. So based of the income, my income say close to $100 or $120, so I will pay something 15%. So how to efficiently protect your long-term cash flow from tax erosion? Next slide, please. So in this slide, you can see it, two investors. One investor we display in green, another investor is blue lines. So you can see it, they both invested $100,000. So they started before 2002 and invested, and you can see how different their portfolio behave, right? So for someone with blue line who invested in stocks, it is go completely, not completely, but it went down, and portfolio lose something and has already close to $53,000 or $54,000 between year 2002 and 2004. In the same time, investor with green line didn't lose anything. It still has $100,000. So you can go and see, come back to normal, return to $100,000 only after year 2012. It is this red circle. But green portfolio, it still produce some money. So now you can see that market dips affects your portfolio and your wealth more seriously. Strategy with downside protection reduces exposure to the market downturn. So as we already saw it, market swing impact investment performance. This is what we have to be aware. So what we need to do, create consistency regardless of market performance. So right now on a slide, you can see it, that it is high cap multi-monthly average index strategy is a part of IUL, designed to control market volatility, minimize human factor impact on stock price. So let's see precisely how it's look like. And we highlighted year 2008, 2009, and 2010. And you can see it, index behave like it was negative 14%, and return displayed 0%. In 2010, index behave differently. It was 21 and 99%. Return displayed 13%. In 2011, index went down, but it was 38%. So return still show 4 and 38%. So this is example is more closer here. We know perfectly well what happened in 2020 when pandemic happened. Pandemic create a big problem for investors and for all of us. So what you can see it on times that someone has this investment of portfolio with this organization, and in 2020 it's still the rate earned was 9.64%. So with this strategy, what I mentioned about, and in 2021, the rate earned was 10 and 92%. So it is, you can see it, it brings some money to the portfolio. So also I would like that you pay attention another strategy which business insurance uses. They use something they call power of zero. They calculate, they grab the value from, say, in our example, March 15, 2020, and grab the value from March 15, 2021. And based on those, they calculated some indexes and performance, and base credited the value of account. Now another strategy. Another strategy, it is 1 year uncapped as an S&P 500 index. So we highlighted 2008, 2009, and 2010. As you can see, index behave negative 38 and 90%. So return was zero, even index was negative. In 2010, index went up 34 and 64%. Return had 27 and 14%. 2011, index down for 13 and 84%. Return still displays 6 and 34%. So in example, you don't lose it anything. You maybe not get it. This is what we display here. Again, we return back to pandemic situation. It is year already 2020. That amount was zero, but it's still a value. It has still some value on account. It's again in 2021, the same day, March 15, and another strategy, power of zero. You still have rate, which is went dramatically up, 41.4%. So interest credit amount was $397.93, and maturity value was growing. So assets and portfolio fluctuate, as we already saw it. So income creates stability. For us, assets, it is something with what we have, for example, real estate, bonds, stocks. It is some valuable thing that can be evaluated and sold. So we need to have something that will guarantee lifetime income. So for us, it is for me, for example, I decided to invest in annuity because annuity combine growth with guaranteed lifetime income. This is what I did in 2000. And my portfolio with this annuity is still growing. And from 2000 to 2025, I can see it grows multiplied 3 times already. So I'm very happy. This is something I will have for retirement probably. So next slide, please. So in what typical clients did? Typical clients use it saving, use it bond, or using stock market. And as you can see, it, bank is saving. It is very stable, not lose it. But inflation can eat this money. Bonds and bills, it is 3-6%, and it's still not so risky as stocks, but still may lose. And 6-10%, it is stocks. So educated client do differently. What they do? They move it assets from a bank and bought different product, right? They, for example, like me in 2000, grow bank saving into lifetime income. So this what I moved from my saving, and I went and bought annuity. This is what another product which called 7702 IUL, which it also goes good things to do it. You're not losing anything. But for me, and probably for most of you, we still would like to have something which will continue keep growing. So it is some kind of stocks, option, ETF. So turning assets portfolio into stable and tax-free income. So stay investment in equity market like ETF, stocks, mutual funds to keep growing the portfolio even during the retirement. So what we mentioned about something called 7702 IUL. So basically, let me briefly, because I know it is difficult to adjust a lot of information, explain. IRS Code Section 7702 defines life insurance contract. It outlines the tax implication for such contract. So we know that when we work, sometimes things happen and we can be laid off, company can be closed, we can lose our 1099 income, our business will produce less money that we expected. So what we're gonna do? So meaning rely on W-2 1099 income alone is risky. So as we already know, some people buy stocks and bonds. And in this situation, when say, I've been laid off, what I'm gonna do, right? So probably if I have stocks, I will sell them because I bought, in my example, for $100 some stocks and sell it for $900. So I got some money. If I'm unemployed and don't have another income, so my taxable income less than $96 and $700, I still will pay zero long-term capital gain tax, which is good. But is it enough? Do I have enough 1 million in stocks? Probably not. So what's gonna happen to me? How can I survive? So this is another thing that I already mentioned to you. It's called 7702 IRA or I'm sorry, 7702 IUL or VUL. This is what product, what basically based on those what I mentioned about tax application and insurance contract, they are not taxable. It is the reason you can see this slide is absolutely green because you will pay no tax. So tax-free investment income supports family and lifestyle goals, if, of course, if you have it. Right now, I have mine, but do you guys have it? So diversify portfolio with 7702 IUL or VUL annuity and tax-efficient strategy withdrawals.
Okay, thank you, Svetlana.
Thank
Yeah,
you.
so that's really concise, but a lot of good information inside because lots of people probably are not aware of a lot of those financial terminology or financial vehicle inside, but it's okay. So today's seminar just to give you some basic foundation, and if you want to know more detail, of course, and it depends whether that will fit in your portfolio, your family's financial goal, and that need to be discussed through the one-on-one meeting. Yeah. So just feel free to reach out to us after this seminar. And right now, I'm going to take over and I'm going to give you some examples mm, about the strategies Svetlana just mentioned, yeah, throughout, yeah, her
Let me introduce,
presentation.
I'm sorry, Grace, let me introduce, guys, that you know who is talking. I'm sorry, I was completely forgot because Grace introduced me. I'm sorry, guys. So Grace has CPA background. She used to work in Big Four CPA firm in Fortune 200 company as internal audit manager for over 10 years. In order to enjoy the time and financial freedom, she decided to transition her career during the pandemic from an employee in corporate America to be a business owner on WFG platform. So she can contribute her professional knowledge and expertise to our community. So welcome, Grace, one more time. I'm sorry for a late introduction.
Oh, it's okay. Thank you so much for your introduction. So I used to work for before, just like most of the accounting major student get out of school, and the first things to work for the accounting firm after a couple of years, and then I came to the U.S. 20 some years ago. I came from Taiwan, so I work in a tech company because I came to California and then settled down in California, stay in California. Yeah. So I work in the tech industry for over a decade as an internal audit manager. So I travel between Southern Cal and Northern Cal quite often. Yeah, just to go to our different facility to do the audit. So one time our company has like some event for us to build a product, yeah, just from scratch. So I was able to go to the clean room, put on the bunny suit, and then we really made the product. So someone asked me, "Hey Grace, where are you?" I don't think that's you. You just grabbed some picture from the internet. Actually, this is me. So you can see, yeah, I did really build a product myself. I was really proud and I show it to my son. Hey, you can put in your computer, but it doesn't guarantee because it's not tested by the quality control. Okay, so that's about me. I transitioned from the tech to the financial service because when I was in tech, I saw a lot of people, and including myself, have lots of the question about taxes, saving taxes, just couldn't figure out how we are W-2 income and how to save taxes. Um, and then I figure out, yeah, I have that question and concern and problem. I'm sure lots of people similar to my situation have the same questions, have the same problems. So that's the reason why I transitioned from a really comfortable corporate life to starting my own financial and tax strategy planning services. And I partner with Svetlana. Svetlana is such a great um, uh, business partner. We work together. She's really good on the tax preparation. So that's why today we partner together. So later on, if you have any question about the tax filing, and then reach out to her, and then I will help with the tax planning. So yeah, it's two sides. So you know, one is tax filing on the compliance side, another one is tax planning, more like an architect engineering your entire tax structure. Yeah. Okay. So let me give you an example, right? So Svetlana talk about a lot of strategy here and there, the concept, but how can we implement, right? So all the knowledge is good, but without the application implementation knowledge, still a knowledge on the book, it wouldn't do anything to you, to your family, to your wealth. So we can look at this really easy example. Yeah, if you want to retire early, I would say early 50, right? And then sometimes people they are not ready to retire, but because companies laid off and companies merge acquisition, they need to really have a career break. So do you have any preparation for that? Yeah. So strategy for some of the tax-free early retirement, because today we want to talk about tax strategy, right? So when we retire, of course, then you can still like generate some income here and there, but we want to make your income is more tax efficient. So we focus more on the tax-free type of strategy. For example, this family, I live in California, so and with the 100,000 income annual income, it's pretty much very important to support a high cost of living here. That's why I use this number. But I know in this webinar, some people are in different state, so the number might not be the same. Yeah. So I just use the kind of like a neighborhood number, yeah, as an example. So Amy and Andy, they need 120,000 per year to support the whole year cost of living. And let's look at this is 2025 when you file taxes. That's the standard deduction you can take. So it depends on the age, right? So I list at the bottom. So with 120,000, actually everybody, if you do the standard deduction, you choose to take standard deduction, and then you can have 31,500 for your 2025 year filing. And then there's something called long-term capital gain, right? Basically, you sell your investment, which you hold your investment for more than a year, right? Svetlana mentioned the stock, right? You hold it for 5 years, you sell it. That's considered long-term capital gain. And the IRS give you a preferential rate instead of like your ordinary income tax. That's for short term, right? It can go up to 20, 30 something. But long-term capital gain, most of people probably stay around 15, majority of people. But for a certain income level, actually your long-term capital gain tax is zero, right? So as long as your taxable income is below 96,700 for married filing jointly, right? Your long-term capital gain, is 0%. So what does it mean? So for a family, maybe especially in the last couple of years, lots of people's like a brokerage stock ETF just like a balloon like a crazy. Yeah. And lots of people probably have quite a bit of gain from the stock. So and when you sell it, and if you can control your taxable income within this range, so your taxable income actually is zero. So what does it mean? That means your federal income tax is also zero because you don't have a taxable income, right? Zero times whatever the tax rate. Yeah, zero. Yeah. So it's one of the strategies Savatana mentioned on the long-term capital gain tax. Lots of people kind of overlook that part, and some places call it like a capital gain harvesting. Yeah, we heard about capital loss. Yeah, capital loss harvesting, but this is capital gain harvesting. Yeah, so you have some capital gain and you want to get it, but how to get it without paying too much taxes? The key point is to control your taxable income. Yeah. So when you are working, it's not easy to control taxable income because your W-2 just show it. So that's why some people, when they are doing the transition or when they are doing the job change or they have some career break, or they want to take some early retirement, that's a time you can start thinking, hey, let's control our taxable income and sell some stocks to harvest our capital gain with 0% income tax. Yeah. So this is kind of like a for the early retirement. So let's look at some people if they really go into the retirement age, like a 65, that's a typical, right? So this is really an example from one of our colleagues. Yeah. So our colleague also do the tax filing, tax preparation, and this couple came to our colleague, say, hey, help me look at how our retirement life, will look like. So we did a projection and then realized this couple actually they can structure their retirement through life insurance retirement plan called LIRP. Yeah, so that's also mentioned by Svetlana, which is defined by the Internal Revenue Code 7702. Yeah, so the tax benefit is defined by the 7702 with this type of investment vehicle, life policy, basically. So this couple right now is 50 years old. So people might think, hey, I just contribute to my 401k, right? So put in 23, 24,000. And if you are like over 50, you can have a catch up. So people still continue to do the traditional. But the thing, traditional account, the problem is it's taxable, right? As an ordinary income tax when you tax the money out. And doesn't matter it's the money you put in or the money you grow. So both the principal and then the interest within the traditional account. So we call it like a joint account between you and not your spouse, but with the IRS, right? So this couple already save quite a bit in the IRA 401k. So we recommend, hey, you don't have that much tax-free account and you maybe need to diversify your portfolio. We know diversification, typically people only think about your maybe investment, right? To diversify low risk, high risk, moderate risk. But the same thing for the tax structure. Svetlana showed you at the beginning, right? Ordinary income tax, long-term capital gain, and then the non-tax. It's also a tax diversification. So we see a lot of family, they don't have that many in the tax account. So we recommend them instead of putting your 401k, start putting in this LIRP, life insurance retirement plan. Why? Let me show you. Okay. So every year still put in 25,000 from 50-year old to 65, 15 years, right? So every year 25,000 for 15 years, 375,000, right? Instead of going to your 401k, you go to this plan. Yeah, so this plan actually is a life insurance policy. So it has a death benefit feature inside. So original face amount is 500,000. Throughout the 15 years, this type of policy can grow the death benefit from 500,000 to a million. Yeah. So that's the funding part. Yeah. And then let's see, when this couple retire, right? And this couple retire actually take out 30,000 a year, just the husband side. The husband start taking out money. We do the illustration from age of 65 when they retire until age of 100, right? As assumption. Yeah. So for like 35 years, every year 30,000, and even till the age of 100, after taking out $1 million, it still leave a death benefit 300,000. That's not a lot, but still good enough, right? So this is the husband side. And then the wife side, wife is also working. So the wife just say, hey, whatever my husband does, and then just do the same thing. So the husband is a little bit younger. So the wife is younger. So start from 48 years old, and then do the same thing, right? So from 48, 49 years old to 63, and then 25,000 per year for like 15 years or 14 years. Total 375,000 contribution. So instead of putting in the traditional 401k, so this couple contribute to this life insurance retirement plan. So the same thing, the death benefit grow from 500,000 to a million. And then when they retire, so this lady, this wife, start taking out the money. The same thing, the husband take out 30,000, the wife take out 30,000. Yeah, so total about like a million, right? And then the wife has 500,000, half million, more than $500,000. Yeah, even at the age of 80, even at the age of 100, when the wife passed away. So with this type of design, actually, you can see, yeah, both husband and wife take out money. Yeah, total 60,000 from 65 years old to 100. So total $2 million take out. And then with the death benefit, 800,000. So let's do some analysis. We can see one is before planning. We see the numbers here. And then one is after planning on the right-hand side. So the Social Security, everybody knows Social Security are still taxable, right? There's a calculation. So that will base on your modified or adjusted, gross income. So it has something to do with the income. So for the Social Security, certain part before the planning, the taxable part is 46,000, and after planning, because we reduce the taxable income, so the taxable Social Security, the taxable part, is only 30,000. So that's a really big saving, just from the Social Security side. Just because you do this type of structure, you are, you are able to reduce like a 16,000, at least $16,500, and that's a big deduction. So that's a Social Security benefit. And then the marginal tax rate before this couple all taxable income. So the marginal tax rate stay at a 22%. Yeah. But because we help them to structure it, so with a new structure, the tax rate can drop from 22 to 12. So you can see it from 22 to 12. So 22 is considered like a median type of tax rate, and then 12 is considered low tax bracket. Yeah. So just because there's like a structure, this couple can reduce at least 10%. That's a big drop, right? But actually, it's not just 10%, it's just number wise. But if you look at it, it's like a 50% less almost. Yeah. So the tax saving for this couple actually can reduce from the tax saving in this year. So you before the plan, this couple pay 22,000, almost 23,000. After plan, the couple pay 5,000. So from 23 to 5,000, that's a total every year. You can save 18,000. So the 18,000 really save it in your account instead of paying to IRS year over year. You save it in your bank account and then you can do some investment or you just do really no-brainer thing to put it in a bank, right? Right? You don't want to worry the market up and down. You say, okay, just the tax saving, from my return, I put it in the bank, right? Really simple, like a CD or like a really safe place for 4% return year over year. So every year, let's say you save 20,000, 4% return 20 years down the road, you accumulate another decent of your asset. So that can increase your total retirement asset or you can leave it as a legacy. Yeah. So instead of paying that 20,000 year over year to IRS, and that will really, give your retirement asset, a boost. So let's look at tax strategy from the retirement standpoint, because lots of people, when I talk to them, they always ask, "Hey, Grace, why have so many accounts? Where should I start when I retire?" Right? So actually, there's a strategy behind that. So let's take a look what you need to do to be more tax efficient to have your money like work harder and then to make the most out of it, right? So we mentioned that you might have a 401k IRA or some other retirement plans, right? And there's a one thing most of people probably are not aware. Svetlana mentioned that earlier, 7702. So that's a life insurance policy. So that type of policy has a cash value, grow inside with a downside protection. So the reason why we want to combine these two because we want to utilize the tax benefit from the 7702. So if you are planning to retire before 59 and a half, because 59 and a half right now is still the age to start, taking your 401k, withdraw from your 401k or traditional IRA, right? So we still use that 59 and a half as kind of like uh, a point to see how to decide the early retirement. So if you retire before that, you cannot really touch your 401k IRA. So what's your other alternative? 7702 actually provide a really decent pool of money for people if they want to tap into some cash inside. So that's why if you are planning to retire early, you already save up a lot and you want to be more efficient to have your assets continue to grow even you retire. 7702 is really great vehicle. And then after 59 and a half, you can start your 401k and IRA or annuity. And the reason why is we know that by the age of 72 or 73, and there's a RMD. So the IRS start, collecting money because you never pay taxes throughout the year when you put the money in the 401k, right? IRA. So IRS say, hey, you need to start taking money out, and like based on your 401k IRA, all those the traditional account the balance, and if you accumulate too much at that time by the age of 72, and you are forced to take out too much even though you don't need it. And when you take out those money, traditional account, you pay taxes based on the ordinary income tax rate at that time. So what's the rate at that time? Nobody knows. Yeah. So that's a question mark. And we want to help people to reduce the risk. So when you can legally withdraw the money from your traditional account, start taking that, right? And then you can, have your 7702 to take a break and accumulate more cash value inside. So after the age of 72 or whatever the RMD age you are at, and then you can start taking money from, for example, your Roth, your 7702, right? So you throughout a year, maybe like over 10 years, your account, Roth account 7702 already accumulate a bigger bucket. So you can start taking more. And remember, 7702 and Roth, they are all tax-free. So whatever the money you take out from 7702 and Roth, actually it's all tax-free. And then you can combine some of the strategy I mentioned earlier, long-term capital gain. right? So long-term capital gain, you can start selling some like your stocks and try to harvest those capital gain, right? And then still without paying your taxes. So with all those vehicle combination, that's why you can create not really 100% tax-free. That will be a little bit challenging, but at least like a really low 10% type of tax bracket, right? So that's our recommendation. So if you have an annuity, that's even better to have a lifetime income structure, just like your Social Security. Yeah. So that's the kind of like most people, yeah, what they have for their retirement account. So just to give you some summary, if you want to bring down your tax bill, right? So one thing is to, especially like for people planning to retire, so keep your tax rate low, right? Because your tax is basically is calculated by your taxable income and tax rate, right? So keep your tax rate low. And how to keep tax rate low, right? Remember those tax location. So one is the ordinary income that's super like high, and then another long-term capital gain, the preferential, and then tax-free. So take the advantage of those tax-free account. Yeah, for example, Roth or 7702, because that type of vehicle can help you to bring down your overall tax rate. Yeah. And then bring down your taxable income. So we mentioned that it's not every income is taxed the same, right? So some are ordinary, some are long-term, and some zero. So remember, right? Do you have a 0% and the type of like a taxable income bucket? If not, maybe you need to start filling up that bucket like a Roth or 7702. So those are really rare one. Yeah, because not many type of vehicle can give you really tax free. Yeah, the government doesn't benefit from that. That's the reason. Yeah. And then also take advantage of those non-taxable Social Security benefits. Yeah, so that really come to how much taxable income you have throughout the calculation. So if you want to know your Social Security, how much is taxable, how much is non-taxable, you can schedule appointment with us, yeah, after this seminar. And then Roth conversion. So lots of people, I think, when I go to YouTube, yeah, I watch those a lot of Roth conversion video. Some say when you retire or during a career break, you have to do the Roth conversion, blah blah blah. And then another like a school of thought say, no, 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 Roth conversion is not for everyone. Yeah, so it's really not for everyone. It's a good strategy. Yeah, but it's not for everyone. Really depends on your income, your asset, and a lot of things need to take into consideration. And that's why when you go to see those YouTube, and right now lots of people go to YouTube as their financial literacy school, but a lot of information, yeah, make people get more confused. So if you even some right now even go to the chat GPT become their financial advisor. So really, really need to be careful because they can only just gather all the information right from the internet, and sometimes they might make like a incorrect suggestion or advice. So always go to the professional to sit down with them and look at your situation. Yeah, so that's the key. So just to give you some brief overview, yeah, about what we do. So here's the 8 pillars we do from a holistic financial solutions perspective. Yeah. So we go from the beginning, maybe when you start working, right? You start saving your money and you put in the emergency fund. But after a while, people save up a lot, 100,000, 200,000. I even see $1 million sitting in the bank. So that means you don't really have your like a make your money work for you, right? So those are the emergency fund and mortgage, right? And then whether you need to buy a rental property, investment property. Lots of people ask me, hey Grace, what do you think about that? Yeah. And then investment and tax strategy always go hand in hand, right? Because when you make money from your investment, and then you need to think about, do you need to pay taxes or not? And then how to control your investment market downturn risks. Svetlana mentioned that. So some of the vehicle actually has a downside protection. So with that downside protection to give you certain certainty and consistency, so you can have more guts to do the risk investment. You don't need to worry. You have a like a safe harbor. Yeah, so that's why I talked to one of my client and she has $1 million in the bank. I told her, why do you have $1 million in the bank? She said, I'm afraid I will lose my savings. So just this type of concept because she doesn't know those like a financial vehicle inside and something actually can help her to protect yeah her hard-earned money. So when I introduced some of the vehicle to her, she's so happy. And then she said, yeah, Grace, yeah, it's good. So I right now I have a guts to do some investment. I said, yeah, don't let your $1 million sleeping in your bank account. So on the right hand side is more like application for the parents if you want to know how to get more financial aid. And then we yeah help the parents to do that. Retirement planning, we have a special seminar. It's a whole big like a topic. And then protection, we mentioned a little bit, like for example, the life insurance protection and also the long-term care protection. Yeah, all these things, and then the living benefit. Yeah, and then estate planning, how to have a generational wealth and pass it to your next generation without paying too much. Yeah, to Uncle Sam. So I talk about a lot, and this is the seminar we do for our community. And at the same time, we open our financial literacy academy to everyone. So if you think today's information is really helpful and then you want to enhance your financial literacy, and I really want to encourage you not just go to the YouTube Academy because like a lot of people over there they don't have a license and they are not responsible for what they say what they tell you. So go to the professional for your financial planning. I think is the key. And this is our today's seminar. We try to keep it nice and short. And if you have any questions, I don't know if you can put it in the chat and let us know. And this is our QR code for scheduling 30 minutes complimentary consultation. Whether you have a question about your tax filing or you want to know more about tax planning, you can contact us. And this is our calendar. You can book a calendar directly, from that link, and then we can sit down to see how to help your family. Okay, so far, and I think we are good, right? On top of the hour, within 1 hour. So far, anybody has question? Or you can put it in the chat. So maybe we will stay another minute or two to see if anyone has questions. So everybody is good. I know lots of information and it's hard to digest everything within such a short amount of time. Yeah, but just feel free to reach out to us. You can scan the QR code or you can just schedule an appointment from the link on this site, and then we can discuss with you and your family to help you to go through this tax season. I think like even I don't like it, yeah, myself. Yeah, no, nobody like paying taxes, right? We work so hard. We want to keep more money in our bucket. Yeah, but we have to pay our share, right? But if the on the textbook and if this is something you can save it, right? So why not just save it? Oh, so the tax law, tax code, yeah, that's the same. Whether that's for Warren Buffett, Elon Musk, Jeff Bezos, they use the same tax code as us. Yeah, but how come their tax rate is really low? Yeah, so it's not like oh, this book is for rich, that book is for non-rich. Actually, it's a book for knowledgeable and non-knowledgeable. I have to say that. Yeah. So just to get know the text, yeah, the knowledge, to help you to save more money. Okay, I think we're good. Yeah, I don't see any questions. So just reach out to us. Yeah, when you have any question later on for your tax filing and tax planning. So wish you guys have a great weekend and smooth on your tax filing. Okay, bye bye.